9,000 silver contracts just disappeared, crashing prices $10 overnight. But this is not the end. Stick around for data proving it. This update is about structure. Leverage broke under pressure. Understanding this reset tells you what comes next for silver traders and investors. Two forces hit together. CME raised silver margin from $20,000 to $25,000 per contract. Year-end positioning reduced free cash. The December silver contract reached final expiry. Traders had only three options: take delivery, roll forward, or exit entirely. No fourth choice existed. After a margin-driven reset, many assume the move ended. Forced selling stops, but positioning doesn't reset instantly. The market enters a transition phase. This post-reset phase decides outcomes, not price targets, not headlines, but structure. Open interest reveals the truth. Falling prices plus collapsing contracts signals forced exits. Pause here. Holding silver, comment your biggest loss from margins. Open interest is like open bets at a casino. When it drops with price, weaker players are kicked out. Before the rollover, December open interest was about 105,000 contracts. Within the final expiry, it dropped below 10,000, nearly 90,000 gone. Where did these contracts go? COMEX traders skip minor months and roll to the next major contract. January gained 4,400, February about 1,600. March became the main destination. Open interest surged from 34,000 to over 114,000 contracts. May absorbed 6,000, July gained 8,500. Yet 8,000 to 10,000 contracts vanished entirely. They were not rolled, they were closed. This is the margin trap, not a market mistake. These traders were not wrong on silver direction. They lacked capital. Margin hikes destroyed rollover ability. In futures markets, rollover is survival. Rolling December to March cost 40 to 65 cents per ounce. 5,000 ounce contracts required thousands in cash. Maintenance margin rose to $25,000. Imagine needing $60,000 overnight to stay in a trade. Most retail accounts could not survive. Positions vanished quietly, structurally, not due to panic. Open interest fell while prices crashed. New shorts were not responsible. Liquidity disappeared instead of transferring. This is why the move felt fast and violent. Once rollover pressure passes, only traders with excess collateral remain. Longer time horizons, more flexibility. Fragility leaves the market. Professional positioning begins here. First signal professionals watch is open interest stability. Price holding while open interest stays low means forced exits are done. Market structure is now readable. Second signal is term structure. When roll spreads normalize, funding stress leaves quietly. Volatility compresses. The market is no longer being pushed, it is being held. At this stage, traders scale smaller, hold higher margin buffers. Survival comes before conviction. Options, markets shift first. Put buying slows, call spreads replace outright calls. Physical markets now matter more. Buyers do not face margin calls, and when futures pressure clears, they quietly absorb supply. Pause. Was this fair risk management or big bank protection? Rebounds feel sudden, not because buyers rush in, but because weaker hands are gone. Liquidity thins, small bids move prices more than expected. Beginners should note, leverage is destroyed fast. Asymmetry matters. Leverage rebuilds slowly. That favors patience, not aggression. Signals align before prices. Open interest stabilizes. Roll costs normalize. Funding pressure fades. Positioning shifts quietly. March holds the bulk of open interest. Trading slightly above spot confirms market has reset into the next cycle. Risk moved from leverage to endurance. Markets built on endurance travel farther. Predict 100 by March? Like if yes, subscribe for updates. Share with silver stackers and comment your long-term price target.